Hey traders, this is Christian from Hertz, Tribeca Trade Group with your week ahead video for September 12th, 2016. And so we're going to talk a lot about charts and what to kind of watch for next week. First, I kind of want to do a post-mortem on what happened last week. What were the catalysts for Friday's sell-off, which were pretty bad, right? I mean, the market ended down, what did we end at? 2.4% decline on Friday. We closed on the lows on heavy volume. This typically does not set up well for a Monday open. When you close on a Friday on the lows with heavy volume, it kind of confirms the trend. So we have a chance to really move lower here in the beginning of the week. But I want to talk what kind of led up to that and the S&P chart and some of those factors. So number one, ECB met Thursday morning. Mario Draghi caught everybody a bit off guard with talking about, number one, no new quantitative easing and no plans for that anytime soon. Also, which was even more alarming, was when the quantitative easing program ends in 6 months, and a lot of people think that it's going to be an automatic renewal. They did not talk about that. They mentioned they have not really discussed what they're going to do about that in 6 months. So what was the reaction of that? Well, bonds really started to sell off here globally. And I think that is the biggest risk right now in the market. So I'm going to go into that in more detail in just a second. But other catalysts were, a couple of things happened on Friday morning. There was a nuke test in North Korea. The market didn't like that so much. Also, one of the Fed speakers, Rosengren, who's been typically a dove, came out and kind of flipped and is now hawkish, talking about it's time for the rate hike, possibly in September. So, where did that lead the markets? Well, with the VIX as low as it is, under the VIX closed 12.5 on Thursday, was actually below that earlier in the week, was below a 12. So the market is kind of priced for perfection with the VIX that low and the S&P not expecting volatility. All you need is a little bit of bad news and it's going to bring volatility into the market. So we saw a couple different things that led us down here. And also the Fed, the markets have not been pricing in a rate hike. While there's been various different Fed speakers talking about the likelihood of a rate increase in September, possibly December, the market has not been pricing that in whatsoever. So if you go to the Fed fund futures, the probability of that happening, if you look at September, it did move up a little bit. I mean, it was at 22%, which was, I think ridiculous in terms of what the expectations were. So it did climb to a 30, but still the market is not ready for this. So whether or not they actually pull the trigger remains to be, is uncertain, is not clear right now. But I could tell you for certainty, the market is not expecting it. 30% probability, that's not good. The market's not realizing that. Even in December, we crawled up from about a 54% chance to a 60% chance. Still too low, I think. So with as much as they're talking about that, I think the Fed meeting is, what is it, the 19th? Check that. And Bloomberg not cooperating with me, but I believe that is the 21st. So I was wrong. The 21st is when we have that rate, the FOMC meeting. So there's going to be a lot of question marks in terms of that. We've got some more Fed speakers on Monday, so that is something to watch. And so I want to go into further about why I think this move in bonds, typically when you see a sell-off in bonds, traditionally, when you do not have a big ECB stimulus program globally, normally that means, okay, there's the bond market selling off is a good thing for equities. Money could flow out of bonds and into equities. Why I think this is not a good thing is because there has been just a huge amount of money that has been going into bond replacements. So in equities, there's been just massive inflows into the REITs, into utilities, as people have been, and people and funds have been searching for yields and going into those areas of the market. That's really where money has been put to work in 2016. Also into dividend funds. HDV, which is the iShares Core High Dividend ETFs, has seen $1.7 billion in inflows. DVY is another fund, $1 billion of inflows this year. Also, these low and minimum equity volatility ETFs, which a lot of people are not even familiar with, USMV and SPLV, some of the biggest asset gatherers in 2016, $7.4 billion have flowed into these two ETFs. Just remarkable in 2016 as bonds have rallied. Also, if you look at, what I've also heard is on, CNBC, on Bloomberg, and a lot of other people have been talking about technology is a good place to go. Old technology is a good place to go into for dividend yields. So even if we start to see this sell-off in bonds, technology is not immune to this. So I totaled up some of these bond equivalent areas, and I came up with a number of $20 billion. That's what has flowed into these areas in 2016. And that is a big danger area, I think, for the market. And why this is a big danger area is if you look at the PE ratio in some of these areas, Bloomberg is not cooperating with me here in terms of associating a PE value with a lot of the sector ETFs. But you look at utilities, even though there's been, which I'm going to get to this, there's been outflows in the last month in utilities. The PE ratio is a 31. In REITs, a 36. Some of those low volatility ETFs, the PE is much greater than a 20. So SPLV, USMV, much greater than a 20. These things are very overvalued right now. So I think you really have to be careful if bonds continue to go further south. And you could look at this, you can either look at ZB, which is the 30-year bond futures, which they actually hit a VPOC. And they broke down. There's been a lot of volatility. They've been trying to figure out which way to go here. So they did see a breakdown, a big breakdown on Thursday, and a further breakdown on Friday. So they are trading below value. They hit this VPOC. If you look at TLT, sometimes these purple lines will act as magnets. So we did not take this one out on Friday, but we've got these ones lower here. So while equities are going to be very interesting to watch when futures open on Sunday at 6 p.m. Eastern, I'm actually more concerned with what's going on here in bonds. I think that is really troubling. It's going to be very troubling if they continue to break down further here. So that is what I'm watching, number one. I do want to look at the S&P futures chart. Let's look at, first of all, the weekly. That's the most telling. Always want to look further out first. And you can see that we broke into value here on Friday. We were not able to hold this top of value red line here. So we fell into value that's below 2118, and what was support is now going to act as resistance. So of course we could come back above here, and I think that would be very positive for the market if we hold this downtrend, or excuse me, if we hold this uptrend here. If we break further here, what I would say is, what you could see is support at this upward trend line that I've drawn here. That's right at, call it, 2191. So we could fall further to 2191. Maybe we'll see a bounce there and a move back. And then one positive I would say is if you look at this hourly chart on the S&P and all the major indices, IWM, Qs, look at how what the level of the RSI is here. It's a 5 on the hourly chart. So it'll be interesting. This thing, it can't get much more oversold than that on the short-term chart. So maybe we process this this level a little bit further. But again, I'm watching the bonds. I think that'll be really telling. A lot of those bond areas make up our sectors in the S&P, and that's not going to be good for the equity market. So I just want to go through a little bit more of the newsletter that we put out every weekend. I talked about levels to watch here in the S&P. I talked about bonds, ETF fund flows. Utilities, healthcare had big outflows for the week. That is now the 4th big week of outflows for the utilities. They could still see more. They could definitely still see more after that. The positive side, what's been seeing inflows, 10 straight weeks now of emerging market inflows. So really, really strong. The last week, just another $854 million of inflows going into emerging markets. Again, 10 straight weeks. So, one thing that you could play here, if you look at the 5-year chart of emerging markets versus the SPY, these things have just kind of bottomed here. And I think these things can continue to run, and on Sunday, if we do see that move down further, or Monday in the S&P, I don't think it's really going to be Asia that brings us down lower. I think it's going to be the U.S. markets. The U.S. markets have been leading here, and Asia's not been the problem here. China's not been the problem. They've had economics that have been fairly decent. So I think you could actually play still going long emerging markets and maybe short S&P. If you look at this 5-year chart, while in 2016 there's been really nice outperformance of emerging markets, but this trend could be just in the beginning here if you look at the 5-year chart. If you also look at SPY versus the trend in developed international markets, you could see that the US has really outperformed here. So whether or not we bounce on this upward trend line or we break down, I do think that Europe and Japan kind of look attractive here relative to US markets. So we'll have to kind of wait and see if this trend line holds here. Again, this is SPY versus EFA, that is international developed markets. So definitely something to watch here. So charts to watch for next week. That's last week's newsletter, which I talked about SMH possibly breaking down. I'll tell you, we really hit a home run in a couple of the shorts that we put on from Friday, and what I talked about the last couple of weeks in the swing trading portfolio. SMH and IYR, those were 2 of our shorts, and we really cashed in on those big time on Friday. But I want to talk about what I'm looking at this week. Regional banks, we saw some big call buying on Friday. And I think if KRE, that's the regional banking ETF, if it holds support of 42.18, I think we could move higher here. That's a benefit of a rising rate environment. Something else people have been talking about is this move up in LIBOR. We haven't really talked too much about LIBOR because it's been flat here for 5 years, since 2009. But you could see that LIBOR has really been moving up here over the last couple months. Where it was back in 2006, 2007, we've got a long way to go, but this is positive for banks. So if we go to the 1 year, look at this move in LIBOR that's taking place here in 3 months. We're now at 85 basis points, just from where we were last year, which was 30 basis points. That's more than 100% increase in the short-term rate. So again, very positive for banks here. So that's, let's keep going to last week's newsletter. What else, I'm watching is home builders really got smacked. This is an area that does not do well in a rising rate environment, and they sure got smacked on Friday. They broke weekly support of 34.79. So what we have next week, also an important report to watch on Wednesday, in addition to the home builders and the home construction names, is also retail, which also really underperformed last week. If we get a positive retail sales report on Wednesday, that may turn into a buying opportunity here in the retail sector, as it's getting a bit oversold. So I would watch out for that on Wednesday morning. If it's a weak report, you could see more of the same, and this group could go lower here, as well as the XRT ETF. And then finally, I talked about some really positive trades that we took profits in on Friday. One thing that did not work very well is I just started to get involved in an XME long trade, thinking that gold miners could go in a positive direction here, as we've seen a lot of money, a lot of ETF inflows going into the materials sector, such as GDX and GDXJ. However, they need to hold this support line here. That's 2480. And that's going to be a cue for me whether or not I add to the position here in XME or actually take it off. If it breaks down, no reason to really stick into a losing trade. So I may have to take that trade off for a loss if we break down further here in the XME ETF. So that's what I'm watching. There's also stocks to watch in our newsletter. You have to subscribe to the Tribeca Trade Group, either the trading room or the swing trade program, to get our full newsletter, which again, we've had some really, really big winners here in trades that we've taken that in that swing trade portfolio. So so you need to go to Tribeca Trade Group to sign up. And again, Sunday night, watch equities and also watch those bonds. That really concerns me more than anything else. So everybody enjoy the rest of your Sunday and enjoy the rest of your weekend. Have a great day.